Right, thank you, David. Ladies and gentlemen, my name's James Ayers. I cover the financial services sector at the Financial Review, which is Australia's national daily newspaper. And I've been having a look at the fintech scene for a little while now. We're going to have sort of a good 10 to 15 minutes for questions. It's a very rare opportunity for you guys to have the opportunity to ask some questions of Australia's regulator in the space. So get thinking about those and send those through, and I'll take a look. Sitting closest to me, we have John Price and Daniel Foggo, who is the Chief Executive of RateSetter. So quite unusual to have a little opportunity to have a chat with the regulator with responsibility for financial services and fintech in Australia. And one of the major platforms is just about to come up to $100 million of cumulative volume, which is all retail investment funds going through RateSetter and out into the market, which makes it quite unusual compared to some of the other platforms. Now, John, I wanted to start with you. Australian fintech regulation generally and P2P regulation specifically is starting to get a little bit of attention from other jurisdictions around the globe, which I think is a little bit strange in a way, given, Australia has probably tried to sort of fit a square peg into a round hole by applying the managed investment scheme laws to an emerging business model like peer-to-peer lending. So I was sort of interested if we could start by, having your views on how that legislative regime has worked in Australia. Other jurisdictions have done it differently with specific laws targeted at P2P and fintech, but we're applying a sort of a different regime to that. How's that serving us? And I understand that the European Banking Authority is kind of looking at the MIS scheme now in terms of applying new regulation to P2P in Europe, which is kind of interesting.
Well, James, I think there's always room for differing views on these sort of questions, but from my perspective, I think that the managed investments regime in Australia has served as a pretty good model for the regulation of marketplace lending. If you think about the regulatory framework in Australia, really there's a strong focus on the substance of what a business transaction is trying to do. And what we see in relation to most peer-to-peer lending platforms in Australia is that there's either a pooling of investment money or there's common infrastructure, a common enterprise to try and help investors make money. And that squarely falls into the regulatory framework that exists in Australia around managed investment schemes. Now, I think there are some benefits for the Australian economy as a result of that. I was unfortunate I missed Paul Clitheroe's presentation, but the managed investment regulation in Australia and the regulation of peer-to-peer lending, it's important to realise that it's not just a disclosure-based regime. So there's a strong emphasis in managed investments regulation around risk management, around the management of conflicts of interest, around important things like handling of client money, and of course on the lending side, if the platform operator is also the lender, there's also the concept of responsible lending. And I think those types of protections will put us in a good position to deal with some of the issues that actually have emerged in some overseas jurisdictions. So some of the issues that we've seen occur in the United States with Lending Club, and also some issues that came out in a recent report that the UK regulator, the FCA, released in early December of this year. So always room for differing opinions, but I think the managed investment scheme model works pretty well for peer-to-peer lending. It's not always the case. I think equity crowdsourced fundraising is obviously an area where a standalone regime would probably be preferable, but that's in train through Parliament at the moment.
All right, John. Daniel, could I ask you just sort of to respond to how you've been regulated under the MIS scheme? How did that sort of process work out, just in response to what John was talking about? But then a little bit more broadly, I'd just like to ask you about your retail customers who are both borrowers and investors on the platform. How have you tracked their understanding of P2P lending in terms of what it is, a new market, and how do you as a platform sort of take your responsibility? What do you think your responsibility is to educate those customers, like we were hearing from Paul, in order, to some extent, protect them from the risk of lending through the platform that they might not be aware of?
Sure. No? Oh, there we go. I think there were sort of three questions in there, and I'll quickly canter through the first, which is how do we think the MAS regime is actually working for retail investors in Australia? I think it's working very well. I agree with the comments that John made. I think there's a few things in there that are really important. The right protections are in place. They're very high thresholds in terms of the protections that are there for investors. I don't think I've ever heard of another protection that's sort of been recommended for investors in the business model that we actually provide. But equally, it provides a lot of flexibility in terms of the different operating models that can fit within that regime. And I think that's important because it makes sure that actually, we can be innovative in terms of how we drive our business forward. We've seen in other jurisdictions like the UK where they've tried to be more prescriptive, the industry's moved on quite quickly, and therefore I think the regulator's sort of gone, the industry has stepped forward, quite a lot from when we first looked at it, and that's actually slowed them down in terms of sort of fixing a regulation. The final component to that is really, I think it allows investors to understand how we're regulated, because there are other products regulated like the way we are, whether that's a fixed income fund or a managed fund or of a different sort. We operate within a similar sort of regulatory regime. So I think that helps the retail investor understand what's actually going on. As to your question about retail investors and do they understand the product, it's a very good question. And I think I'll sort of answer it in a sort of roundabout way. What we're trying to do at RateSetter is really build an alternative to the traditional banking model. We are trying to give retail investors access to loans that they haven't been able to access previously, and to close the spread between the investor and the borrower. And I think we're doing that effectively. Our borrowers are experiencing great rates, our investors are getting great returns, and they're getting the returns that they expect. We're also trying to take away a lot of the risk in lending from the government or from the taxpayer, and we're putting that on to the investor, which I actually think for the financial system as a whole is not a bad thing. But the new model we're trying to create, which we think is a better model, or sits well alongside the banking system model, we need to make sure that there's wide adoption in that model, otherwise we're not relevant. We can have a better model or a different model, but if no one's using it, there's little relevance. And the way to make sure that a lot of people are using it is to make sure that you've got retail investors participating. So, in Australia at the moment, we've got about 6,000 retail investors. In the UK, it's about 50,000. We want to bring our product to very much being a typical, normal part of one's investment portfolio. How do you do that? You make sure that you've got a lot of retail investors. You need a license to accept retail investors. And then why would a retail investor adopt your product? Because it's simple and they understand it, and the risks are understandable, and actually the risks are low. So we're very aligned with ASIC in terms of making sure that our product offering is really simple. RateSetter designed, I guess, the next, an iteration of peer-to-peer lending, which is to have a provision fund. So we provision for losses. It makes it a very user-friendly experience for the retail customer when they're actually lending on our platform. So I think that answered your second question. And the third was...
the third I was sort of going to, kind of talk about your responsibility to sort of educate and protect investors.
Yeah.
But I mean, just quickly, because we can move through.
Sure. Yeah. Our number one priority at RateSetter is making sure our investors get the return they expect, that they get every cent of interest and principal due to them. That's our track record, and if we don't continue to do that, then our business won't survive. So it has to be our first priority.
Look, I've had a question sort of come through on from the floor, which is to you, John, and it's talking about, last year we saw proposals that ASIC be given strong competition mandate in financial services, and does ASIC have an appetite to do more work to boost competition? That's an interesting question I'll put to you, and also just sort of add on over the top of that. We heard Daniel sort of talking about the UK potentially running into some issues with overly prescriptive regulation, whereas Australia tends to be much more principles-based. But you also have these powers to issue waivers, and maybe in addressing that competition issue, are you going to be more willing to issue more waivers and let more companies sort of come into this space outside the traditional confines of the Corporations Act?
Okay, so firstly on the competition mandate, I need to start off with the obligatory note that whether or not the government decides to proceed with that is a matter for the Parliament. But if I can provide a bit more meat behind that, this is something that we raised in various submissions to parliamentary inquiries. It's not unique. So the UK Financial Services Regulator, the Financial Conduct, has a competition element to their work. And let me be clear, I don't see that if ASIC were to be given a competition mandate, we would be doing the sort of work that the ACCC does. Really, what I think is important is that ASIC be able to consider competition issues when it is looking to get the best result for consumers. And believe it or not, under our legislation as it's drafted at the moment, there's a real question about whether we can do that. So that's where I see there's some benefit in having a competition mandate. On the flexibility of the Australian regime, look, the Australian regime is reasonably flexible in how it treats businesses. And that's within the law itself. There's a whole range of exemptions, so not all of them are relevant to peer-to-peer, but there's quite a wide range of exemptions that let people operate financial services businesses here in Australia without a licence. And in addition to that, the licensing obligations you have depends very much on what you decide to do. So when ASIC gets a licence, there are always 3 questions that we look at. What products is this person wanting to offer services in relation to? What services do they want to provide? And what sort of clients are they going to provide those products and services to? And your licensing obligation will depend very much on how you answer those 3 questions. So if you want a full-blown licence covering every single thing you can do, issue derivatives, issue securities, provide advice, run a managed investment scheme, provide a custodial and depository service, and you want to do that for retail and wholesale clients, you could expect a lot more obligations will apply to you than, for example, if you simply want to run a wholesale-only marketplace lending scheme. So there's that degree of flexibility that's already built into the system. But what makes Australia fairly unique is that we also have quite wide powers to grant waivers, to exempt people from provisions in the law, or in some cases to actually change what the law says. Now, when we do that, we need to be respectful of what Parliament has intended when it's enacted legislation, and we need to do a cost-benefit analysis. So, our own internal decision-making around this is always we look at the regulatory detriment if we did what someone asked us to do, and we weigh that up against the commercial benefit that would flow through if we made that decision to grant one of these waivers.
And have you issued many of those waivers in this space, fintech space?
In the fintech space, what I can tell you is I would be very confident that every marketplace lender that's currently operating with a licence in Australia has one of these waivers in one form or another. More generally, what I can say is we receive thousands of these waiver requests every year, and we grant between about 70% to about 85% of them, depending on the relevant time frame you look at. So it's a very common feature of the Australian market. It's a very important feature so that we can adopt the regulatory framework to changing business and changing circumstances. And I think it's served the Australian economy very well.
All right. Daniel, your parent company, RateSetter, being in the UK, I'm just interested in how, your evolution of a fintech in Australia has been shaped by the experiences of RateSetter in the UK. We heard from Rob Young from On Deck at the start of the day, sort of talking about this more liberal regime for data sharing in the UK and mandatory referral of SME lenders to alternative lenders out of the banking system, and these government-led initiatives that we don't have in Australia yet. I wondered, to what extent the guys in London look to Australia and say, look, are you operating in a good regime here? Is it harder for you? What's the relative sense you get?
Sure. It's got louder. So firstly, I guess a lot of our DNA was set from the UK business very early on, and that, again, was a core focus on retail investors, making sure that we delivered the sort of simple and safe product, the returns that the investors expected. And that really has, it's just so fundamentally important to what we do every day, and it features even in, the feedback we get from our customers. 90% of our customers give us sort of 5 out of 5 stars on product review. So we've really tried to build it as a very customer-centric business. And then the next component, I think, is just that imperative to just keep improving and keep driving innovation in your business. RateSetter in the UK, in the first year of their existence, changed their model a number of times until they found the model that they thought was, the right model for them. And I think we're trying to follow that lead in many ways, through transparency. We were the first lender in Australia to release our loan book. We've got lots of other initiatives during this year that we expect to launch. So it's making sure that we, are just, trying to provide a better product for our customers. How do they look at Australia? I think they look at it with a bit of envy, actually. When they look at our regulatory regime, we sort of touched on this earlier, there's talk amongst the operators in the UK and possibly also the regulator about whether a collective investment scheme was the right way to regulate the industry there, which is very similar to a managed investment scheme structure that we've got in Australia. So they look at us with some envy. They look at us with some envy in terms of the market structure here. It is similar to the UK, but actually, the spreads, the typical spreads between depositor and someone borrowing money for a personal loan is actually wider here than what it is in the UK. So there's definitely sort of learnings both ways.
Yeah. Look, and can I also ask you, Daniel, just about your philosophy on collaboration? We've seen ongoing discussion for a few years now about the sort of carnivores or the herbivores. Do the fintechs work with the incumbents? Are they against them? Are they trying to steal their market share? Are they going to be a new, outlet for them or a new channel for them? And there's horses for courses and plenty of different sort of views on that. I mean, even in the Australian market quite recently, we saw one of the P2P lenders who is retail regulated to take retail in Moneyplace. Auswide, one of the smaller banks, took a majority stake in them, so there's sort of movement afoot in this space already. But look, what are your views on collaboration, Daniel? Is it sort of getting in bed with the enemy to do a partnership with one of the major banks? What's your sort of philosophy about disrupting the orthodoxy?
I wouldn't say the enemy, in that we need banks. We use banks for a lot of the services we provide for payments and so on. So we know they're an important part of the infrastructure in our financial system. And I think there's no right or wrong answer in terms of collaboration. What we've tried to do, is, like I touched on at the start, is build a different model, an alternative model. And we've got confidence in where we're going as a business that we'll actually build a significant scale business. And so partnering with the bank, and next month we should be lending about $10 million. One of the big four is only lending in terms of P&I, personal loans, just over $50 million and a month, and the other three are not that far above that. To actually partner with them when actually you're hoping to very soon be lending more than them in a month potentially creates a lot of conflict over time. So where we've looked for partnerships, it's been more on the corporate side, for where businesses can actually help drive our growth in a tangible way without the conflicts. And so car sales, investing in our business and partnering with them was a very natural fit in that regard. But again, I think it's important that some businesses try and challenge the status quo. I think there's a lot of logic for others to actually partner with the incumbents.
All right. Look, I've got quite a few questions coming through, so thank you everyone for sending those in. One for you, John, and this is slightly outside the P2P space, I think, but the questions are, do you think that balance sheet lenders, I think we're talking about online business lenders, but ones using their balance sheet rather than a P2P marketplace, are engaged in regulatory arbitrage, i.e. they're acting like banks without being regulated as such. And I suppose the issue there is that the online business lending scene in Australia sort of is carved out of the Corporations Act and sort of is unregulated, which is an unusual situation compared to other jurisdictions where it is regulated, and the regulation brings requirements about the disclosure of fees and consumer protections and all the rest of it. So do you think there's a bit of arbitrage going on by those guys?
The first thing I should say is actually balance sheet lenders have a very long history in Australia. So many of you might more be familiar with their more common name, which is debenture issuers, because that's exactly what a balance sheet lender is. It's a debenture issuer. It's a different framework from a managed investment scheme. There are different obligations. There's an obligation to appoint a debenture trustee. There are a whole raft of legal obligations that are set out in the Corporations Act. Is it a regulatory arbitrage? Look, it's just a different structure, and different structures have different protections and different risks, different disclosure standards as well. So, I think the existence of debenture issuers hasn't stopped, for example, property schemes using the managed investment format. It's just really a question of business choice, and then importantly it's a question of investor understanding. And I must say I do commend Daniel for his comments. You know, I think product issuers in any form of business really can do themselves a great favour by trying to educate their customers. In the end it'll mean less complaints, potentially less disputes, and it will really help things. And let's face it, you know, in Australia we are coming off a fairly low base in terms of financial education, and that's the same everywhere in the world. You know, the UK released a survey a few years ago, and the headline figure was that 50% of the population in the UK did not understand what 50% meant. That was the actual finding. And I think you might find a similar finding here.
John, could I also ask about the incumbent responses to fintech? You've recently established a regulatory sandbox. I gather there's one in the UK and one in Singapore as well, to let fintechs start to test their business models, maybe pivot to something different, to try to sort of work out what they're doing before they have to go through the whole licensing process. So interesting to sort of see how that goes. But are the incumbent banks going to be able to sort of utilise that sort of sandbox?
Okay, so the regulatory sandbox that we have in Australia is made up of a few elements. On the legislative side, remember that the object of a regulatory sandbox is really to be able to test ideas without a regulatory approval or a licence. So in many instances, there are exemptions in the legislation here in Australia itself that means you don't need a licence. So that's one element. In other cases, ASIC can be approached by individual entities, and we can make a decision about whether to grant an individual waiver, and I spoke about that previously. Those two things are what forms the regulatory sandbox of most overseas jurisdictions. So if you have a look at the UK, you have a look at Singapore, they only look at sort of fintech business models on a case-by-case basis. But in Australia, I'm pleased to say, we went one step further. We actually sat down with a blank sheet of paper and we thought, right, what sort of business models are there where actually we think it's pretty safe for people to test these if they meet some conditions? So you wouldn't even have to approach the regulator to do that. But that last bit I mentioned, that sort of whitelisting approach, that is only available to fintech innovators, to fintech startups. It's not available to fintech incumbents, and that's because we think they've got the resources and the understanding of the regulatory system to be able to get a variation of their licence. So certainly incumbents can come to us on a one-on-one basis and ask about testing products, but if you're talking about the class waiver that we have, the whitelisting approach in our regulatory sandbox, that is only available to fintech startups.
And it's not fintech incumbents, you said, can't use it either, not just the banking incumbents,
it's
startups.
It's actually fintech startups.
Yep.
So if you look at the way it works, the key question is, does the person or an associate of that person already hold a licence? The answer to that question is yes, then you're going to need to go down the individual path. If the answer to that question is no, you may be able to rely on our class waiver.
Okay. Well, look, thank you, gentlemen. We've run out of time. I'm being approached from the side of the stage, which was my warning sign to wrap things up. And the closer you got, the faster I needed to move. So that's it. So thank you very much for your time, John and Daniel. Appreciate the conversation. Thank you.
Thank you.
Thanks, James.